Hey guys, Carl, Alan, want to show you what a forecasting model looks like for investors. So I'm actually going to split this video into two parts. So this is video one of two. We're not going to worry about bolt-on acquisitions in this video. I'm going to do that in the second video, but it's the same model that you can download if you want to use this on your deals. So what I'm going to do first is just focus on one generic deal. You buy the business, you raise a bit of equity capital to allow you to buy it, and then you're forecasting what the value of that equity is going to be for your equity investor, for your equity partner. So we'll do that for forecast A in this video, and then in another video that I'll do next, we'll look at how the forecast changes if you do a bolt-on acquisition. So first of all, let me apologize. I'm a little bit lispy today. I'm wearing my new set of Invisalign retainers, trying to straighten my teeth. I'm going on a TV show later this year, and I want to have nice, clean, and straight teeth for that. So 53, I have teeth that are 53 years old, so trying to get that squared away. Hence why I got to wear my aligners, and I'm a little bit lispy. So I'd have taken them out to talk, but they're really tight and they hurt, so I'm not going to do that. All right, let's get to it. So the first thing you want to do before you start a forecast is you want to put in the existing deal numbers. So let's say we're early 2024, you're looking at a business and you have the last 3 years of financials. So all the blue cells are the cells that you're going to populate, right? Everything else don't touch, only play with the blue cells when you download this model later and you play with it. So let's look at this business. Let's call it Project Beef. This business is a real company, actually. This was a food processing company and kind of like a farm shop in the United States. Was a really good deal that we reviewed on one of our protege deal review calls, and I kind of wanted to share it with you. So we put the revenue in. So 2021, 3.3 million and change. 2022, 3.9 million and change. 2023, about the same. So the model calculates the growth on the year-to-year trajectory. You then put in what the gross profit's going to be. That's going to be in the accounts that you get from the seller or the broker. That automatically calculates your cost of goods sold and your gross profit margin, which is really important. And then the overheads, which we call SG&A, sales, general, and admin. Those you don't need to calculate because what you're looking for is the number, the adjusted EBITDA number. So EBITDA is the profit measure that we use when we're valuing deals. We don't use SDE. I explain that in a different video. If you've not watched that video, go watch it. I explain the difference between EBITDA and SDE and why we always use EBITDA. And then when we talk about adjusted EBITDA, we're talking about reflecting the add backs and the take backs to normalize that profitability for us as the owner. Again, if you don't know what that means, I did a video on that. Go watch that and I'll show you what take backs and add backs are and how to spot for them. So assuming you know what adjusted EBITDA is, that's the normalized profit, the recasted profit that you're going to see if you were the owner of the business in those 3 years. So you plug that in. So you're looking for three numbers really: revenues, gross profits, adjusted EBITDA, and then the model calculates all the rest, including the free cash flow. Then what you do is you then need to build a forecast. So the first thing that you're going to do is you're going to look at growth. So it's not just okay to tell the investor what your growth is going to be. In this example, we just put 20% annual revenue growth in this business. You need to justify it. You need to explain, what are you going to do to grow the business? Are you going to spend more money on marketing? Are you going to go into new areas of the market? Are you going to introduce new products or services? Doesn't matter what the business is. You can't just put growth numbers down. You need to justify them with what you're actually going to do and how you're going to measure that performance. It's really, really important. So in this example, we've put 20% growth. Always do a 5-year forecast. It's really, really important. So 5 years at 20% growth. And then what we're doing is we're forecasting what the gross margin is going to be. So when you own a business and you scale it, you're going to get economies of scale, right? Both at the gross margin level and at the EBITDA margin level. Why is that? So let's say you're a plumbing company and you go out and you're fixing bathrooms and doing all those things for customers, right? The more you spend with your suppliers for tiles and faucets and taps and pipes and all those different things, the more you're spending with a supplier, the cheaper the costs are going to be. They're going to give you better deals because you're spending more. It's a higher volume for them, right? So as you scale any business, your cost of sales, your cost of goods sold is going to come down as a percentage of the top line revenue. So that means your gross margin can go up. So what we're doing in this example is just every year, we're just going to nudge the gross profit margin up by 1%. It's currently at around 68%. We're going to nudge it up a bit closer to what it was a few years ago. So it's a 68, then we'll nudge it up to 69 in 2025, 70% in 2026, 71% in 2027, and 72% in 2028. And then we're also going to do the same with overheads, right? The overheads are obviously going to go up as the business scales, but the size of the overhead as a percentage of revenue is going to come down. Because, for example, let's assume you have an office lease, right? That office lease is the same cost to you if you don't move or expand it, whether you're a $3 million business or you're a $10 million business, right? You're sweating that overhead. So what that means is as you scale the business's revenues, your overheads as a percentage of sales come down. So in the current year, we're at 33%. So what we're going to do, sorry, that's the margin, 34.3% is the SG&A percentage of revenue in 2023. So for 2024, let's nudge that down to 33%, then to 32%, then to 31%, then to 30%, then to 29%. So by shaving a point a year off the cost of sales and by shaving a point a year off the SG&A, that's kind of like got a double impact on the EBITDA margin. So, and the model calculates all this for you. So the EBITDA gets calculated. This business was doing $1.3 million of EBITDA in the current year. That's going to go up to 1.6 and change, then 2.1 and change, then 2.7 almost, then almost 3.4, then $4.2 million and change, right? So that's the full forecast. So we've got all the numbers for the current, and then we've got all the numbers for the forecast. The next thing that the model does is it calculates the valuation. So what's the business worth today for us to buy? So we take a 3-year average. If you don't understand that, there's a video on that. Go watch the valuation videos that I've done on YouTube. But basically, we take a 3-year average. If the EBITDA is going up, we take a 3-year average. If the EBITDA is coming down, we only take the current number. But be careful that you understand why it's declining and you have a plan to turn it around. Otherwise, don't buy it. But normally, you want to see a nice increase in that EBITDA. It shows the business is prospering, it's growing, and it's becoming more profitable. So the 3-year average, the model calculates that at 1.169 million. We're going to apply a 3.5 times multiple to buy this business. It's an average business, I would say. As you know, there's a range of multiples in any industry by size of profit. So I looked at the Deal Stats database or pitch room if you have that, or pitch book, and you can see about 3.5 is the type of multiple you would pay for this business. So the enterprise value of the company, the business, not the equity, we'll get to that in a minute. The value of the business is just over $4 million. And then we're going to add the real estate. So the real estate is a separate purchase. That's been appraised at just over 900,000. So we add that in. And then we're going to make some adjustments for debt-free, cash-free, and net working capital, right? So there's about $500,000 shortfall in really the working capital in this deal. It's not got a lot of working capital in the business. It's kind of one of the only things about the deal I don't like. So we're going to make an adjustment for that. So the model adds all that up. This business, including the real estate, is going to cost you $4.5 million almost to do it. And then let's look at how much capital we need. So 4.494 is the value of the deal. Then we're going to add in $250,000 of additional working capital to top it up. We don't need $500,000. 250 will be fine. We're taking the $500,000 to reduce the price, obviously, but we can get away with 250. And we're going to do an SBA deal to buy this company. So with the SBA fees and the closing costs for attorneys and DD and all that stuff, probably about $100,000 on this deal, and then you can add it into the financing. So the total deal is going to cost about $4.8 million. It'll be a 13-year SBA deal because there's real estate involved. If it was purely a business acquisition, it would be 10 years. If it was primarily real estate and a small business, it would be 25 years. So the SBA blends the kind of term. So this is about 13 years, and the interest rate, let's say it's 10%. You can get it down probably to about 8.5 these days, but let's use 10 to be conservative. And then this deal under the SBA, we had it underwritten as 5% buyer equity, which is 242,000, 90% SBA loan, which is 4.4 almost, and then 5% seller notes. The seller will carry 5% of this deal. So what the model then does is it also factors in capital expenditure. That's the CapEx that was put into the business. And then we're forecasting how much CapEx we're going to need to continue to trade this business. So 7, 8, 9, 10, and then drop to 5% in 2028. So that calculates all the debt service, calculates all the free cash flows for us, which is absolutely brilliant. So then what happens, and this is a real skill, is so you need an investor. So let's say you approach me and say, hey, Carl, I've got this great deal. Here are all the numbers. Absolutely fantastic business. I've qualified for an SBA loan, but I need a 5% equity investor. I need somebody to come in and give me the 5% of the total deal. I need $242,000, please, Carl. You can be my partner in this deal. Now, obviously, I'm not just going to buy 5%. If I'm putting the money in and you're not, then I'm going to want a higher piece of equity. And let's say we negotiate that I'm going to take 15% of the business. So I'm providing you the equity capital, which allows you to get the SBA loan. You're putting absolutely no cash into this deal whatsoever. So you loan 85% of the business, and I loan 15% of the business. Now, what I want to know is what's my equity going to be worth in 5 years' time? Let's say the plan is we're going to buy it, we're going to scale it, and then by 2028, we're going to sell this business, and I'm going to get my money back, my 242, plus my shareholder premium to reflect the increased value of my shares. What does that look like? And if you pitch an investor without this information, they're going to say no. Watch my other video about the 5 killer questions an investor is always going to ask you. This is question number 5. What's my risk-adjusted return on investment? How much money am I going to make by investing in this deal? If you can't forecast that and you can't tell them that, they're not going to invest, right? So definitely download this after this video and you will be able to look at it. So let's see how this works. So what we're doing is on an exit, let's take the same 3-year average. So the 3-year average of EBITDA on exit is 3.446 million. And then at that level, at that size of profitability, we're going to be worth around an 8 times multiple. As you know, the bigger the profit, the bigger the multiple, right? So we're going to sell for an 8 times multiple. So that's going to give us a valuation of around $27.5 million on exit. Let's say the real estate's appraised to about $1 million during that time. It's interesting, right? A lot of real estate investors don't understand this. Real estate might appraise a little bit over 5 years. A business, you can massively increase the value, right? It's a lot easier to grow the value of a business than it is the value of real estate. So in this example, 27.5 is the value of the business. Let's have the real estate. And then at the time, in 5 years, we've probably paid around half of the SBA money, probably a little bit less, just a 13-year loan. So we're going to have just under $3 million of debt still sat on that balance sheet that needs to be paid off at closing. And we've got other additional debt as well that's factored into this model. So the debt-free, cash-free, the 100% equity valuation of this business is going to be about $22.16 million. And if I own my 15%, which I do, I'm getting $3.3 million back from the $242,000 that I've invested. So what the model does, it calculates 2 very important numbers for me. First one is my return on investment, my cash on cash return on investment, which is how much cash am I getting out? 3.3 million and change, divided by how much cash did I put in? $242,000. So 3.324 divided by 242 is 13.73 times. So I'm making almost 14 times my money by partnering with you in this deal, right? So obviously I'm going to invest. But then what I'm also calculating is what's called the internal rate of return, the IRR, or sometimes called the CAGR, the compounded annual growth rate. And what that does is it works on yeah, I'm going to make nearly 14 times my money, but how does that compound as an annual percentage interest increase in that money? The model works it out over 5 years. It's almost 69% annual growth. So for me, if I leave my money in the bank, I might get 1% if I'm lucky. I have a private banking relationship. I get about 1% a year on my liquid cash, which is terrible. I'm going to get 69% a year if I invest in this deal. So this is your deal, and you can quantify and explain exactly how you're going to grow it. I'm going to be doing this deal with you. So that's kind of forecast training number one. What we're going to do next is we're going to show how the returns go absolutely crazy, how they go a lot higher by doing a bolt-on acquisition. So I will show you that in another video. So definitely hit like and subscribe if you want to get access to all these other trainings going forward. And then definitely click the link around the video to get access to the download of this model so that you can play with it on your deals and you can forecast the investor returns on your deals so you can get your deals closed. All right, guys, hope you enjoyed that. I will see you soon. Until then, bye for now.